Hi, I'm Mark with Arlington Hall Investment Advisor. So far, we had suggested your to-do list as a business owner needs to include sell my business. Step one was to create a culture that rewards solid performance. Next, transition key employees to owners. And although you pray your transition will go through without a glitch, finding you and your key employees holding hands and skipping down the yellow brick road of financial success, prepare to protect your firm and your client relationships if all does not go well. About 10 years ago, an article described the disastrous fate that awaited a business owner who failed to employ proper protection. In a word, if you do not have agreements in place for your employees, get one. If you do, but you're concerned about its enforceabilities, have it reviewed. There are three different types of agreements to protect your firm. One is the restrictive covenant agreement. This is a document that either prohibits or restricts an employee from diverting client accounts from your firm in the event that that employee leaves your firm. Two is a non-competition restrictive covenant agreement. This is where your firm seeks to prohibit the employee from accepting employment in your industry for a certain period of time. Three, and this one is what finds favor with a lot of consultants, it's called a non-solicitation restrictive covenant agreement. This is where your firm seeks to prohibit the employee from soliciting to or rendering services from your firm's clients, wherever the clients happen to be located and for a certain period of time. It should also include a provision to restrict soliciting of your firm's employees. For instance, make sure that a former employee cannot contact employees for the purpose of inducing them to leave your firm. The agreement should also contain some form of a confidentiality provision in which the employee promises to maintain the confidentiality of all your firm's information, client information, proprietary processes, or technology. How to handle restrictive covenants? Well, one, beware of the overbroad restrictive periods in states that are not what is called a blue pencil jurisdiction. Firms run the risk of having an overbroad covenant agreement dismissed in its entirety. When should you execute a restrictive covenant agreement? Well, the agreements should be executed immediately by the employee prior to or upon commencing employment. Consideration. You should not present the agreement to an existing employee without first checking whether the state in which that employee is located is a consideration state. Liquidated damages. In some restrictive covenant agreement cases, your firm may wish to consider a provision that requires the departing employee to compensate your firm in the event that clients terminate their relationship with your firm and engage the departing employee. Let's have a look at the entire internal succession process. There are four basic agreements. Number one is the restrictive covenants that we've already talked about. Number two is what's called a representative agreement. Three is a purchase agreement. And four is a shareholder or operating agreement, sometimes called the buy-sell agreement. Two other alternative structures include one, compensation planning. Compensation planning comes in four flavors. One is non-qualified deferred stock option plans. That's a stock option program that allows owners to gradually transfer ownership to key employees at a specified later date. A phantom stock plan. This is a program that compensates key employees for participating in the firm's success and its growth without actually transferring any ownership. If a stock option plan is properly structured and administered, the key employee should feel like an owner. Three is a restricted stock bonus. A restricted stock bonus program allows the firm to provide its key employees with stock bonuses instead of cash compensation. A properly structured restricted stock bonus plan allows for the transfer of ownership to key employees without producing any current taxable income for that key employee. Four is a rabbi trust, or non-qualified deferred compensation plan. The rabbi trust is commonly used in structuring non-qualified deferred compensation plans. It is an irrevocable trust established by the firm on behalf of the employees. Firms tend to favor the use of rabbi trust because it can provide golden handcuffs for certain key employees. Another popular use of Rabbi Trust is to fund the owner's succession plan. Next, let's look at shareholder agreements, or again, what's referred to as a buy-sell agreement. The three most common types of buy-sell agreements are 1, a cross-purchase agreement, 2, a redemption agreement, and 3, a hybrid cross-purchase redemption agreement. Cross-purchase agreements allow the remaining owners to directly purchase the shares from the selling owner or the selling owner's estate. The surviving owners generally receive a step-up in tax basis equal to the purchase price paid for the stock. However, if an acquiring owner plans to retain the stock until death, this step-up in tax basis may not be realized. Redemption agreements. These permit the firm as an entity, not as individual owners, to buy the stock from a selling owner. Of course, the firm must have some type of liquidity. Unlike in a cross-purchase agreement, the other owners do not receive any step-up in tax basis of their stock when your firm redeems the selling owner's stock. The third type of buy-sell agreements is called a hybrid or a wait-and-see agreement. It's a cross between cross-purchase and redemption agreements. This agreement provides you with the greatest flexibility. So how does a buy-sell agreement work? Well, a well-crafted buy-sell agreement should identify not only who the successors of your firm will be, but also how, when, and where the succession will take place, as well as the funding method. It should address how the purchase price for the stock of the exiting owner will be determined. What method of funding will be used in paying the purchase price? When the purchase price should be paid to the exiting owner? And finally, where the purchase will actually occur. The better method is to formulate a purchase price depending on each of the various triggering events. For instance, a buyout price in the event of a death, say, should differ from the buyout price in the event of an exiting owner that was terminated, say, for cause. In addition, if an employee failed to adequately transition his or her client accounts and relationships to the remaining owners, then that exiting owner's buyout price should be reduced. The buyout price will generally be used based on some type of valuation formula that the owners previously agreed to. A capitalization method, or say a formula based on a multiple of the firm's cash flow, gross revenue, or net operating income. A practical method of funding the buyout is through life policies and/or disability insurance policies. Generally, the insurance premium payments are not deductible by the firm, and the insurance proceeds are not taxable income for the firm. When a buyout results from a triggering event other than death or disability, the required cash must come from the remaining owner's personal assets, firm cash reserves, or loan proceeds. Otherwise, buy-sell agreements need to provide the remaining owners to purchase the stock under some type of promissory installment note. Let's review considerations before executing the succession process. 1. Transfer of ownership techniques. In an outright sale to the remaining owners, or say the potential owners, the sale is generally structured as a stock sale versus an asset sale. As a rule of thumb, a seller prefers a stock sale while a buyer prefers an asset sale. Generally, the buyer pays the selling owner a lump sum payment equal to the purchase price for the stock, or a lump sum payment comprised of some certain percentage of the purchase price, plus a short-term or a long-term installment note to pay the balance of the purchase price by a certain date. 2. Conducting appropriate due diligence. For internal successions, conducting due diligence starts with new employee screening. It should include carrying out a comprehensive review of all new employees' background checks regarding his or her relevant experience, designations, disciplinary history, potential conflicts. If the new owner intends to transfer existing client relationships to the firm should obtain a list identifying the number of clients that the new employee currently services. Next, regulatory considerations. Your business may already be regulated. If it's not, chances are it will be at some point. First, if any of the firm's filings need to be amended to reflect changes in its officers, directors, members, and/or ownership. Second, the firm must determine whether internal succession will cause an assignment of its existing client agreements. Act smartly on your succession work. Consult with your advisor. Otherwise, hire an advisor to assist with your specific circumstances. Start early so you can find the cracks in your planning and fix them in order to boost your chances to realize a better income. Click Contact to chat with us or learn more for more information on your specific circumstances.